Recently, Reserve Bank of India has released a discussion paper on the regulatory framework of NBFCs. And it is now being regulated on the basis of scale-based approach. Like Reserve Bank of India would like to regulate the NBFCs on the scale-based approach. It will be quite interesting to observe the transition of NBFCs from one stage of regulation to another stage. Now, with the increasing role of NBFCs in the financial intermediation, the regulations have to be progressively tightened to protect the customers and the user base. If we observe the financial intermediation pattern in India that has evolved in the last 20 years, we can say after the post-reform phase, NBFCs have been catching up with new size, dimension, interconnectivity with the financial system and the spillover risk. As a result of which, it will be quite interesting to see how the NBFC sector is going to evolve and shape up in the years to come. NBFCs are now proposed to be bifurcated into 4 groups by Reserve Bank of India. That is, the base layer, that is NBFCs will be bifurcated into base layer, that is the initial first base, which will consist of about 9,200 NBFCs. That is the largest chunk of NBFCs which will be grouped under base layer, having a turnover of rupees 1,000 crores. And middle layer, this is the next layer which will have larger NBFCs, but number of NBFCs will be less. So this will be those NBFCs which are including deposit taking companies and housing finance companies and other companies which are doing middle level of business. So middle layer is the, I would say it is the heart line as far as the pyramid of NBFCs are concerned. The next layer is the upper layer. That is the top 30 to 40 NBFCs will come under this category, which will be systemically important NBFCs. That is, whose spillover impact on the risk management systems and stability of the financial system will be influenced. And there is a 4th layer which will be known as a top layer. Top layer will be categorized by Reserve Bank of India in future as and when the size of the NBFCs grow and their riskiness rises and their size and dimensions and interconnectivity with the financial markets and the spillover risks are more pertinent. So taking into account the holistic view of the regulations that are going to come up, the base layer, middle layer, upper layer and top layer, NBFCs will be segregated. Then the entry level capital, which was at rupees 2 crores entry level, has been increased to 20 crores. So a big jump as far as the entry level NBFC business is concerned. And the upper layer will be almost regulated in line with the banking system. That is, they will have to have a capital adequacy, they will have to have corporate governance systems, subcommittees for the board, that is the audit committee of the board, risk management committee of the board and the credit committee and other committees akin to the banking system. So the point is, those NBFCs which will be under the upper layer, they will be of very significance as far as the financial intermediation system in India is concerned. Now, why this much of emphasis on NBFCs? Because if you take the share of NBFCs in the total financial intermediation system, in 2010 it was about 10 to 12%. Now it is more than 25% of the total market share. And another concern is the deposit taking companies, where the protection of consumers are very, very essential, their numbers are rising, their size is rising, their asset size is rising. Now the total asset size of the NBFCs as on March 2020 works out to about 32 to 34 trillion, that is Indian rupees. As far as banks are concerned, it is about 182 or 180 trillion Indian rupees. So compared to that, the NBFC size is growing much faster and at a greater pace. So as and when the significance of their role increases as a supportive role to the banking system in financial intermediation, their regulation also assumes equal significance. Now what is the significance of NBFCs? When we compare with the banking system, banking is a much more regulated and formal system of providing financial services. NBFCs have enjoyed the regulatory arbitrage, that is, we can say that it is a light touch regulation as far as the NBFCs are concerned. That is why still in the new format, the base layer NBFCs, there will not be much of change as far as the regulations are concerned, because they will be continue to have the light touch regulations. But middle and upper layer will progressively have regulations which are closer to the banking system, because their size and riskiness is going to be comparable to any of the banks. So that is the reason that regulations are going to be enhanced. Now when we come to the regulatory part of NBFCs, it has started in 1964, when Banking Regulation Act and RBI Act both have been modified to empower RBI to regulate the NBFCs. After 1964, it is recently in 2007 and 2008, RBI has issued new regulations stating that they need to have a CRO, Chief Risk Officer, and they need to have corporate governance in place, and they need to adhere to the capital adequacy and classification of NPAs. Now, so far, the NPA norms for NBFCs were 180 days as against 90 days for banks. So now the upper layer of NBFCs will have 90 days norm. So that is what is the change that is going to happen. So looking to these changes, NBFCs are going to play a much more dominant role, and when we put together NBFCs, fintech companies and peer-to-peer lenders, digital lenders, all these NBFCs into one group, then their share in the market will increase and will multiply many times. Keeping these increased role and riskiness of NBFCs, RBI has increased the regulatory surveillance on these financial entities. So this is going to bring a very big change as far as NBFC sector is concerned. And another thing the NBFC sector is doing, they are providing lending services and they are providing financial services to those who are not eligible for banking services as per the banking standards. That is, we can say that whenever a loan is to be given, we go into the track record of the borrower. That is the history of track record of repayments, and they need to have credit rating. But NBFCs have their own internal rating system, which is, and also the due diligence tests which they conduct, and they have a closer oversight on the borrower's conduct, as a result of which the recovery rates in NBFCs are much better when compared to the banks, for the reason that they closely chase the borrowers once the loan is given, and that is the reason why the transaction costs in NBFCs are higher, and the interest rates are also higher. So taking these two aspects, there is a benefit to the consumers on one side, that they are in a position to get access to the financial services on relaxed conditions, and they are not familiar with how to obtain finance from the formal financial system. So there is a lot of financial education that goes into the connect with this segment of customers. So all these things put together, NBFCs are being geared to assume greater role in the financial system.